Hey everyone, this is Ethan Ballard, and this is my financial analysis presentation for Accounting 370, financial statement analysis. So let's dive right in, shall we? Alright, so today we're going to be talking about the Federal Express Corporation, more commonly known as FedEx. You can see it on tickers as FDX. It has been a titan in the transportation industry for the past several decades, has provided air courier services all over the world to large and small businesses alike, along with several different e-commerce platforms and many different government entities as well. However, as big as it does have some competitors, which can be seen in the United Parcel Service, or UPS, or larger freight companies such as XPO, and even the United States Postal Service. Okay, for FedEx's income, as you can see on the slide, net income has moderately decreased over the past 3 years. And this is largely due to lower demand on global shipping, as well as FedEx's interior cost cutting measures that they've instituted over the past few years. Despite this, operating income, profitability, operational efficiency, all of these have held steady, along with gross profit margin, which is held at about 22% over these past 3 years. All of this to say, FedEx has reflected strong financial management through these trends, even though it has also reflected some weakened growth. However, this also indicates that FedEx's earnings quality is strong, since this growth, however weak as it is driven by operating improvements rather than revenue expansion. Alright, for FedEx's cash flows, the company has shown an overall cash position that has been both strong and stable over the past 3 years. Understandably, operations have been the primary source of liquidity since they've consistently generated positive cash flows over the past 3 years, which reflects strong company performance. Investing activities has shown cash outflow every year, which is also understandable, and this is mostly due to asset purchases, as well as long-term investments such as Drive and Network 2.0, which we'll discuss more later. Financing activities have varied from year to year, which reflects changes in debt and equity. All in all, the company has demonstrated a healthy cash flow management since it balances investment with operating activity successfully. Alright, on to ratio analysis. As we can see here, FedEx's liquidity ratios have steadily declined over the past 3-year period, though these ratios have remained higher than their closest competitors, such as UPS or XPO, as we discussed earlier. They have still been lower than the industrial average. Leverage ratios, such as debt to equity, have also declined, but this reflects improved long-term financial stability, so still very good for FedEx. Activity ratios, such as turnover, have also decreased, but this does sadly reflect weaker asset management within the company. These ratios have generally stayed lower than competitors, but higher than the industry average. Profitability ratios, such as net profit margin and return on assets, have increased slightly, which is also very good. These ratios have generally stayed below competitors, but still above the industry average. So again, very good for the company. Market value ratios, such as earnings per share, EPS, have also risen over the past 3 years, which reflects very good investor confidence in the company, and as well as improved market perception. On a similar note, let's move on to market valuation. FedEx's valuation has, despite the company's decreasing in revenue of the past 3 years, clearly moved upward. This can be seen in the company's stock price, which has shown an overall upward trend, indicating a strong investor sentiment towards the company. This can also be seen in the value of the stock, which the market value has clearly exceeded the book value, which also indicates many unrecorded assets, such as brand strength or a strong customer loyalty. More intangible assets that could contribute to the perceived value of FedEx as a whole could also be reputation or market position. It's also important to remember that FedEx, like any other company, does have certain strengths and weaknesses that need to be taken into account when analyzing it. Some of these strengths include strong liquidity. FedEx is known for having a much higher liquidity rate than its closest competitors, like, say, UPS. This means that it will be able to meet short-term obligations much more quickly. Similarly, FedEx is also known for its consistent net income, which, though it has decreased slightly in recent years, has only decreased slightly. Again, strong investments such as Network 2.0 and Drive represent another strength. On another hand, weaknesses for FedEx may include heavy investment in fixed assets. Now, this may limit future cash flexibility, so hampering the company. Higher debt levels. These are improving, but still are below industry averages, so again, holding the company back. And market valuation is heavily reliant for FedEx on unrecorded assets, which, such as brand loyalty or reputation, make market value harder to measure. Alright, now that we've covered the past 3 years of this company, let's take a minute and look forward into what will be the future of FedEx. Though we can't say for sure, it's more likely than not that the decline that we've seen from 2022 to 2024 will continue through 2025, largely due to economic instability and financial uncertainty. In future, though, it's more likely than not that the company's healthy cash flow and liquidity position will carry it further into a more long-term stable environment. Along with this, what else will help is the company's strong investments. Network 2.0, Drive, both of these will save the company multi-billion dollars in the last half of the decade, helping to streamline the organization. This, along with forecast growth of e-commerce in the incoming years, all contributes to a positive investor outlook for FedEx. And finally, in order to achieve a truly well-rounded analysis of this company, we need to look at FedEx through the lens of a biblical worldview. For instance, FedEx has always sought to maintain stewardship over its financial assets, which is synonymous with the teachings in Proverbs 21:5. In addition to this, in recent years, FedEx has sought to decrease its amount of standing debt, which indicates that the company is moving towards a stage in which they can be more accountable for their own finances, which is, again, synonymous with the teachings in Proverbs 22:7. And lastly, The company's investments and long-term preparation indicate that they are seeking to maintain a long-term stable financial situation, which follows the guidance in Proverbs 13:11. Alright, and that's all we have for today. Thank you so much for your time. If you have any more questions, please feel free to let me know. I'd be glad to answer them. Thank you once again. Until next time, Godspeed.